Hello. It's the 8th of November 2022. Last week, Analysts says to sell Keppel REIT. So, I buy. So, let's look at the reports. So, the Edge magazine, they reported that on the 3rd of November, Goldman Sachs downgraded MPAC's Keppel REIT and FCT to sell. It's quite rare that the analysts call for sell. Normally, they say buy. And at most, to hold, right? Selling is quite rare. So I think there's a lot of fears in the market already. Capitulation, I call it in a previous video. So the reasons for the rating cards are, of course, the interest cost lah, higher for longer and what. And then on the 4th of November, JP Morgan also downgraded to underweight. Again, borrowing costs will double to 4% by 24. And what? By the way, I think there's only one thing I think I should do, and that is to buy. So I bought something at 87.5 cents on the 4th of November, which is when they downgraded. So the share price just dumped that day. And I didn't know what happened, but I look at the historical numbers and I thought, oh man, I should just buy and I bought. And then after that, over the weekend, I discovered, oh, they downgraded. So let's look at the charts. Look at the Keppel REIT charts, maximum, right, or all the way back. Look at this. GFC went to 50 cents. After that, look at it, right? This level, the 87.5 cents, 88 cents level is 85 cents level. It's quite supported. In 2011, the Euro crisis, people worry that the world is going to end, and therefore they dump. And then after that, 2016 China devaluation and world will go into a recession and depression, and they all dump. And GFC, the COVID in 2020. They worry that the people will never go back to the office and the office will be useless. They all dump. And now it's dumping again at 87 cents. But look at it, right? After GFC, boom, 1 year later it's up. After the 2011 Euro crisis, boom, 1 year later it's up. China worries, 1 year later, boom, it's up. The COVID worries, and 1 year later, boom, it's up. So you know what? Look at the historical patterns. I think things will repeat. So that's what I buy. So look at the numbers. The DPU for the first half is around 3 cents. So full year roughly 6 cents. And NAV actually went up to 133. So off a price of 87.5 cents, look at the 6.85% yield and 60.65 price to book ratio. Of course, this will go down because rates are going up. I think it's quite sure that the Fed will raise rates maybe to 5%. I don't disagree with that though. I just disagree with how long the Fed can actually keep rates there for. I think if they keep rates there for 3 years, 2+ to 3 years, the world will be in a very, very different place, man. So let's calculate, right, mathematically, how much the impact to capital rate will be if the Fed hike rates to 5% from current 1%, right? So if you add up the total debt borrowings, this is of the 30th of September. So they have roughly 3.4 billion of debt altogether. And then 28% is on floating, right? 72% is on fixed. So the impact instantaneously, immediately, from a 4% rate hike is 3.4 billion of debt times 28% floating times 4%, that's $38 million, right? So immediately we're gonna have a 38 million impact from rising rates because this stuff are float, right? So next year in 2023, they have this pillar to refi, and let's say half of it is fixed so 300 million, right? So 300 million times 4%, that's around $12 million, right? That will be the impact of year. And the year after that, there'll be around 800 million to a refi. So let's say 400 million is to be refied. So that's around another 16 million, right? So immediately 38 million. Then next year probably around 15 million. The year after maybe 15 to 20 million. I think that's what you are looking at for the next 2 years 2+ years. And I think the manager actually did something quite smart. So they say they want to celebrate the 20th anniversary in 26. So they distribute $100 million over the next 5 years. So 20 million per year, right? So if you think about it, right? This year the impact is 38 million. Next year around 12 to 15 million. The year after that 15 to 20 million. And this 20 million, right, will be distributed each year for the next 5 years, right? So this will arrest the decline in the DPU by quite a fair bit. But of course, some people will argue saying, oh, these times you should be conservative and conserve cash and be prudent, right? Well, I think the manager is quite confident of what's going on, right? So they can distribute cash, right? I mean, they look at the 2020 period when the COVID period struck, they did not distribute the capital that way, right? they could have said that oh, they want to celebrate the 15th anniversary and distribute, right? But they didn't do it, right? So because back then there was so much uncertainty, I think this time around they are quite aware of what they're doing. So I think it's a vote of confidence, I think. And look at the office dynamic in Singapore, which is what I'm quite interested in. Look at the rent as of September 22, right? It's 1160. So it's back to the actually surpassed the previous highs pre-COVID already, you know. And look at what's happening in the office dynamics. I think it's strong, man. I think the office dynamic in Singapore is strong. Singapore is a bit of a safe haven, especially what's going on in the Hong Kong and China. Oh, people just wanna, I think the business proposition for Singapore as a business hub has just strengthened post-COVID. So well done, government. And look at the supply dynamic. I think the office rental dynamic looks good for this REIT. And this guy owns so much of the grade A office in Singapore, right? I think it's a very big beneficiary of strong rental. Of course, if the recession hits strong and fast, then you also cannot avoid. But as of now, I think there's also scope for rental reversions higher for the next few years. So I bought the REIT. Not much bullet left already. I already fired a lot over the past 2 months. So well, the markets have forced my hands. So good luck, everybody.